The asymmetry of losses dictates that a 50% market collapse requires a 100% recovery just to break even, a mathematical reality that liquidates the unprepared while the disciplined minority compounds their wealth. While the average investor treats a 40% drawdown as a catastrophe, the data-driven strategist recognizes these cycles as the ultimate catalyst for long-term outperformance. This analysis breaks down the precise mechanics of why your compounding is fragile and the 3 specific actions required to ensure you are the one buying when the market inevitably resets. The vast majority of participants in the financial markets are currently hurtling toward a cliff edge, destined to hemorrhage capital during the next inevitable correction. What is truly baffling is the sheer lack of comprehension that will accompany this downfall. These individuals will succumb to a primal psychological sequence where fear triggers an immediate liquidation of assets, ensuring they depart the arena with significantly less than their original seed money. However, a lean, disciplined cohort of strategists exists. These people possess an architecture for their wealth that allows them to exit the turbulence with a balance sheet that is actually more robust than when the storm first hit. You have to wonder, why does the mainstream herd remain so blind to the mechanics of their own financial destruction? My objective is to provide you with the blueprint for a compounding engine that treats a market meltdown as a high-octane fuel source rather than a catastrophic failure. Standard financial media is saturated with vague platitudes about holding for the long haul, yet it consistently fails to provide the tactical manual for the present moment. When the indices eventually crater by 30%, 40%, or even a staggering 50%, you cannot afford to be the one frantically hitting the sell button at the absolute nadir of the cycle. Instead, you must be the predatory buyer waiting in the wings. Having scrutinized decades of market cycles, I am not interested in providing a sterilized or comforting narrative. You deserve the unvarnished reality because volatility is not a glitch in the system. It is a fundamental feature of the investment landscape. Failing to master the navigation of these resets guarantees the avoidable loss of your hard-earned capital. To rectify this, we will dissect the mechanics of how growth functions during a downturn, as it deviates sharply from common intuition. I will then outline a trio of concrete actions you can implement immediately to fortify your position. Finally, we will examine the cold, hard empirical data that validates why the prepared mind consistently outpaces the reactive one. If you value this type of rigorous analysis, show your support for the channel and let us dive into the technical details. Consider the inherent vulnerability of growth. We are taught that compounding is a relentless upward trajectory where initial profits act as a foundation for subsequent returns, creating an exponential curve. This phenomenon is so profound that it was reportedly dubbed the eighth wonder of the world by Albert Einstein. Yet, this engine is surprisingly delicate. Like a glass sculpture in a high-traffic hallway, its beauty is matched only by its susceptibility to a single careless move. The primary issue is that the average person views growth in a vacuum, completely. The exit door of the stock market is often a trap, not an escape. When investors decide to flee during a downturn, they are not just avoiding a drop, they are actively cementing their own financial ruin. Selling at the absolute floor of a market cycle turns a temporary dip on a screen into a permanent destruction of capital. Once that money is pulled, you are no longer a participant in the inevitable rebound that follows. Historical data proves that missing even a handful of specific dates can decimate a lifetime of savings. Consider a comprehensive study conducted by Fidelity that tracked a theoretical $10,000 investment into an S&P 500 index fund starting in January 1980 and ending at the close of 2022. Those who had the iron will to stay the course for the entire 42-year duration saw that initial seed grow into a staggering $1.08 million. It is a testament to the sheer velocity of the market that missing just the 5 most profitable days out of more than 10,000 total trading days would slash that $1 million sum down to a mere fraction of its potential. If an investor were unfortunate enough to miss the 50 best sessions, the outcome would be dramatically worse, leaving their portfolio in a state of absolute stagnation. Think of compounding like a high-speed locomotive. It requires immense energy to gain momentum, but if you pull the emergency brake, you don't just stop, you lose all the kinetic energy you spent decades building. Every time you interrupt the process of compound interest, you are not simply hitting a pause button. You are effectively dragging your financial progress back by years or even decades. The question you must confront is not whether a massive market contraction will occur, but rather if you possess the strategic readiness to survive it when it inevitably arrives. Success in finance requires a shift in perspective, moving away from viewing a market crash as a freak, once-in-a-century lightning strike. In reality, market volatility is as predictable as the changing of the seasons, though most people treat a winter frost like an apocalypse. To navigate this, we must categorize these events by their severity. The first tier is the standard market correction, which is defined as a decline of at least 10% from a recent peak. These are not anomalies, they are routine maintenance for the global economy. Since 1980, these 10% dips have occurred roughly every 1.2 years on average. If you have been investing for 5 years and have not yet witnessed a correction, the statistical reality is that you are severely overdue for one. You can view this level of decline as the market hitting a necessary reset button after prices have sprinted ahead of actual economic value. The second tier of intensity is the bear market, a more serious contraction where the index falls by more than 20% from its previous high. Since 1932, these events have surfaced every 4 to 5 years. While they feel interminable when you are in the thick of them, they are actually quite brief in the grand scheme of history. The average bear market lasts approximately 289 days, which is just under 10 months of struggle. Contrast this with the average bull market, which gallops forward for 965 days. Growth cycles are nearly 3 times longer than the periods of decline, yet our brains are wired to focus on the short-term pain rather than the long-term gain. Finally, there is the full market collapse, the rarest and most violent tier of all. Understanding these levels is the only way to remain rational while everyone else is succumbing to the primal urge to run. The nightmare of the market crash is rarely just a number on a screen, it is the moment when the external world and your internal finances collide with devastating force. When the economy buckles, catastrophes tend to travel in packs. You might face a sudden layoff exactly when your car transmission fails or an unexpected medical bill arrives, and these cluster risks are statistically more likely to strike during a broad downturn. Without a dedicated cash buffer, you are stripped of your choice and forced to liquidate your portfolio at the absolute bottom just to survive. This isn't a case of being struck by lightning or having bad luck, it is a fundamental failure of structural planning. While a high-yield savings account generating 4 to 5% interest might seem unremarkable or even boring compared to the adrenaline of the stock market, its role is vital. Think of this liquid cash as a physical barrier or a heat shield that protects your compounding engine from the friction of real-life emergencies. It ensures you never have to sell your long-term assets when they are essentially on clearance. By maintaining this boring pile of cash, you buy yourself the right to stay invested when the rest of the world is being evicted from their positions. The second pillar of survival is the transition from manual, emotional investing to a mechanical process known as dollar-cost averaging. Instead of the high-stakes gamble of trying to time the perfect entry with a massive lump sum, you commit to injecting a fixed dollar amount into the market at relentless intervals, whether that is every week, every fortnight, or once a month. This strategy turns market volatility into your most powerful employee. When prices climb, your fixed capital naturally purchases fewer shares because they have become more expensive. Conversely, when the market takes a dive, that same dollar amount aggressively scoops up a much larger volume of shares because they are priced at a bargain. Over a long enough horizon, this behavior systematically drags down your average cost per share. It is a strategy that gains speed when the market loses it, automatically supercharging your accumulation at the exact second prices hit their floor. For the prepared investor, a market crash is transformed from a tragic disaster into a massive inventory clearance event where everything you want is suddenly available for less. Consider a practical 3-month window to see how the math of a crash actually works in your favor. Imagine you commit to investing $200 every month into a standard index fund. In the first month, while the market is stable, shares cost $20, and your money buys you 10 shares. In the second month, the market suffers a violent collapse, and the share price is sliced in half to $10. Your $200 does not shy away, it buys 20 shares. By month 3, the market begins a partial climb back to $15 per share, and your monthly contribution secures another 13 shares. After 90 days, you have deployed $600 and ended up with 43 shares, bringing your average acquisition cost to just under $14 per share. If the market had simply stayed flat at $20, you would have ended that period with only 30 shares in your account. The volatility was the catalyst that allowed you to own nearly 50% more of the market for the same price. This is why you must automate the process. When your screen is bleeding red and the headlines scream catastrophe, your biological instinct will be to freeze or flee. That visceral fear is the precise signal that you should be buying more. By removing your hands from the steering wheel and letting the machine take over, you eliminate the human emotion that sabotages wealth. Finally, you must audit your diversification strategy before the storm arrives, because most people are far more exposed than they realize. Owning 10 different high-growth technology companies is not a diversified strategy, it is a concentrated bet on a single sector. True diversification requires you to build a financial fortress by spreading your capital across entirely different asset classes, economic sectors, and geographic regions. The objective is to ensure that when one corner of the global economy is being dismantled, other areas act as a stabilizing counterweight to soften the impact on your total net worth. You want to build a structure that can weather any specific regional or industry failure. Diversification acts as the structural foundation of a resilient portfolio, though the exact proportions of your assets will shift based on your biological age, your appetite for risk, and the specific duration of your investment timeline. The fundamental objective is to avoid the catastrophic error of placing your entire fortune on a single outcome. When you spread your capital, you unlock the ability to rebalance, which is the mechanical process of liquidating a portion of your winning assets to subsidize the purchase of those that have declined. This creates a forced discipline of selling high and buying low, a total reversal of the self-destructive instincts that plague most retail investors. Over the long haul, this constant calibration ensures that the miracle of compounding is distributed across your entire wealth structure, rather than being restricted to a few lucky outliers that happen to survive the storm. It functions like a ship with multiple watertight compartments. Even if one area is breached, the vessel remains buoyant. Maintaining this discipline is deceptively difficult when the market is in a state of euphoria. It feels counterintuitive to extract capital from a stock or a sector that is currently dominating the charts. Why would any rational person decide to sell off Tesla while its trajectory continues to defy gravity? Yet, it is precisely this type of concentration that leaves investors defenseless when the cycle turns. History provides brutal reminders of this reality. During the 2008 financial crisis, banking and financial stocks were obliterated, losing over 55% of their value. Years earlier, the dot-com implosion saw technology equities vaporize more than 70% of their market capitalization. Those who refused to diversify did not just see a dip in their net worth, they watched decades of compounding progress disappear in an instant. However, even the most sophisticated strategy will fail if it cannot survive your own biology. The ultimate determinant of investment success is not your spreadsheet, but your psychology. When your portfolio begins to bleed, your brain triggers an evolutionary response designed to protect you from physical predators, urging you to flee and stop the pain immediately. This is the mechanism of loss aversion, a phenomenon famously explored by psychologists Daniel Kahneman and Amos Tversky. Their research demonstrated that the psychological agony of losing money is roughly twice as potent as the joy of an equivalent gain. To our primitive minds, losing $1,000 feels twice as painful as winning $1,000 feels pleasurable. This is a hardwired biological reality, not a lack of willpower, yet it is absolutely fatal to long-term wealth. The only effective defense against this internal sabotage is to make your most difficult choices while you are still calm, rational, and detached. You must construct a written investment plan on physical paper. This document acts as your external brain when your internal emotions are in a state of high alert. It must explicitly detail what you own and your specific rationale for owning it, alongside a clear definition of your risk tolerance. Most importantly, it should contain pre-written protocols for how you will react if the market craters by 20% or even 40%, as well as your intended holding period. When the headlines predict a total collapse, this document serves as a cold reminder that you anticipated this volatility and have already committed to a course of action. It is the same cold logic that guided figures like legendary fund manager Peter Lynch through the darkest periods of market history. The catastrophic paradox of the Fidelity Magellan Fund serves as a haunting warning for every modern investor. Between 1977 and 1990, the fund achieved a legendary status by delivering an average annual return of approximately 29%, a track record that remains one of the most formidable in the history of finance. However, the data reveals a shocking contradiction. Despite these astronomical gains, a massive contingent of individual investors in that very fund actually lost money. This failure was not caused by the fund manager or the economy, but by the investors themselves who chased performance like a desert mirage. They flooded the fund with capital when returns were hot and fled in a panic the moment the market dipped. Their emotions effectively dismantled their financial potential, proving that even the best vehicle in the world cannot save a driver who refuses to follow the map. You must resolve to be analytically superior to that impulsive crowd. The cold mathematics of the market reveals that the most profitable days are often hidden in the heart of the storm. Research conducted by J.P. Morgan indicates that a significant majority of the top-performing trading sessions in history occur either during a crash or immediately in its wake. To illustrate this, consider the 2008 financial crisis. 7 out of the 10 most profitable single-day returns in S&P 500 history were recorded during that period of extreme volatility. When you sell during a downturn to protect your ego, you aren't just cementing your losses, you are effectively blinding yourself to the rebound. This is the tragic irony of the panicked mind. The very people who run from the rain are never there to catch the sun when it breaks through. Because of the mathematical asymmetry of losses, where you need significantly larger percentages to recover what you have dropped, being absent for those few recovery days is not just a missed opportunity, it is a permanent scar on your long-term wealth. Reflect on the brutal reality of the 2007 to 2009 financial crisis to see how iron discipline pays off. Over those 18 months, the S&P 500 collapsed by approximately 57%. For an investor with $100,000 at the peak, their balance sheet would have shriveled to a terrifying $43,000. It was a period of pure psychological warfare. Yet, for the individual who continued to deploy $500 every month through the duration of the slide, the story ended differently. By buying shares at progressively lower prices, they were effectively stocking up on assets at a steep discount. When the recovery finally arrived, those specific shares bought during the darkest days of the crash transitioned from liabilities into the most powerful engines of their portfolio. For those who stayed the course, the crash functioned as a launchpad rather than a grave. The 2020 COVID crash provided a more recent lesson in market velocity. The S&P 500 plummeted 34% in a mere 5 weeks, marking one of the swiftest declines ever recorded. Many investors saw the speed of the drop and surrendered at the absolute bottom. However, the market reached a full recovery by August 2020, just 5 months later. Those who maintained their positions or intensified their buying during the dip were rewarded with extraordinary gains over the following 2 years. This wasn't a stroke of luck, it was the inevitable result of allowing the mechanics of compounding to function without human interference. You must accept that market volatility is a feature of the system, not a bug. Statistical history shows that 10% corrections occur every 1 to 2 years, bear markets of 20% or more arrive every 4 to 5 years, and systemic collapses occur roughly every decade. If you plan to be in the market for a lifetime, you will inevitably face all of them. To survive, you must protect your compounding from your own impulses. First, secure a genuine emergency fund so you are never a forced seller. Second, automate your dollar-cost averaging to turn your wealth building into a mindless machine. Third, diversify your holdings so a single industry failure cannot destroy your life's work. Most importantly, draft a written plan and sign it. The individuals who accumulate true wealth are not the smartest people in the room, they are simply the ones who were prepared for the storm before the first drop of rain fell. Now, you are among them. Note that this information is for educational purposes only, I am not a financial advisor, and your personal results will depend entirely on your own actions and decisions.